A couple of weeks back, we spoke to someone who was an analyst based in Nigeria, and one of my first assumptions or investigations revealed that there are a lot of banks up there, and they all look pretty good because they're big and well established. But what's your sense of what's going on there in the sector? I know you spent some time on the ground in Lagos.
Yeah, we carried out some research there, and we spent about a week there. I think valuation-wise, the banks look quite undervalued, but we think there's still some risks in there.
Right.
We are a bit concerned by the credit risks. I think the whole issue related to the rescued banks remains an overhang. So it's a bit tricky. There are some well-established banks which we think will probably pull through. Our co-holding there is Zenith Bank,
which is the largest, right? Zenith,
yeah.
I think, in terms of its scale and activities and capitalization.
Yeah.
In fact, talking of size, just give me a sense of this. I think I asked you this question before on Twitter, is what scale are we talking about here in terms of their comparable market cap? Is Zenith, for example, the size of Standard Bank? Is it the size of, African Bank, the size of Capitec?
Yeah, they're much smaller, when you compare versus the South African banks. So your Zenith, your First Bank are probably the size of your slightly lower than ABIO.
Okay, so about 25, 30 billion rands worth, but obviously in Naira.
So they are within Capitec to ABIO region, but they are not your first rand. Okay,
and as you indicated, they've been through sort of a regulatory environment where they've all been cleaning them up. We know that Lemido Sanusi is a fantastic, central banker. So things do look good. We know this is a massive economy with enormous potential. So one of the obvious ways to get an investment in the sector would be to look at the banks in that environment. But you're concerned a little bit, just expose that again, you're concerned a little bit that there could still be threats to them in terms of the sort of reorganization and re-regulation?
Yeah, when you look at banks with the NPL ratios of around 10, over 10 for some of the banks, non-performing loans over 10%. For example, for Diamond Bank, it becomes a bit difficult, to know how much of it is going to come through again. Then you look at the coverage ratios. I think they boast quite strong coverage ratios, but I think there is still that risk. I think, in our view, risks related to the to credit has waned. There is enhanced supervision from the CBN, but it's still a market where you do not have ID systems. It's still a market where the credit bureaus are quite young, so data series related to that, so that you can know how much, or profiling your clients better is still a problem. So it's still there are still some question marks.
Yes. Okay, now you're based here in South Africa. You're Zimbabwean, right?
Yes.
If I had to assume from the people that are friends with you on Twitter. Now, outside of Nigeria, are there other African countries where for you the banking sector looks attractive?
Yeah, I think Kenya is. I think generally, it's really more of the same issue like your telecoms, where people look at penetration, where people look at growing per capita incomes, where people look at, for banks, people would then look at the return on assets to say how much of unlevered profits is still in the system. So almost all of the sub-Saharan markets still rank quite nicely in terms of penetration, low penetration rates, and per capita income growing.
Lots of blue sky potential.
Yeah, but it would differ from country to country. I think we initiated coverage a few months ago in Kenya. In Kenya, we liked some of the banks. The Equity Bank, I think we still like it.
That's your favorite up there?
Yeah, it has rallied quite a bit, but we still see some upside. KCB, we still see some upside. Yeah, duals on Barclays Bank and Stanchart, I think quite strong franchises, but we think they've been losing quite a bit of some market share, and I think they are probably in a market where everyone is very aggressive and they are a bit, conservative. Okay. And I think we had one sale on Cooperative Bank, which we just thought it carried a bit of some significant NPL overhang risk.
Okay, there was a viewer which sent us a question. It was a woman called Wendy Marisic. We spoke earlier in our segment about her. She also asked, if you're looking at investments in Africa outside of South Africa, would you go with something like the Standard Bank exchange-traded note, which they just launched, which kind of gives you the top 30 or 40 stocks or something? Or do you think it's worth doing your homework and finding a broker and getting involved directly in some of these stocks? Do you think the opportunity is larger? You obviously are doing work to establish those that are undervalued, right?
Yeah, yeah. Well, it probably depends on one's risk tolerance. I mean, if you think that you can probably go, because I think the Standard Bank, to me, it's more of a passive way, really. In my view, I wouldn't want to hold 40 stocks in my portfolio.
Okay. And obviously, from Legae's point of view, you are an institutionally oriented brokerage firm. I know you do retail as well, but the institutional pitch, especially now with your deal with Peregrine, means you're looking to get institutions that are running Africa funds themselves, using you guys, your research, and looking for better than average opportunities. Okay, I've got one final question for you, and that is, we're talking banks in particular here, but one of my favorite pet theories is that in the post-2008, 2009 financial crisis era, banks are subject to more tight regulation, rules around capital adequacy. They get pressure and pushback from government and regulators if their executives are paid too much. Is it true that banks are going to be a sort of boring, low return type of asset class for the next 40 years? Or do you think this is just a short-term thing that's going to pass and the heyday and excitement around banks globally is going to return?
I think at some point, regulators will probably allow banks to earn, returns that justify the capital. Otherwise, we would want to invest in banks. So we continue to see issues, especially related to the Basel III, for those countries that will take it. I think the main issue is on the capital as well as liquidity. Right. But capital adequacy ratios, if you say a bank should probably hold capital for around 12 to 13, it can still really earn a return on equity of around 20, 25, 30, depending on the leverage you allow the bank to carry. So to me, that would still be something that is acceptable, that people can still say, okay, we look at it and invest. But if the liquidity side of it becomes very stringent, then you probably see banks continuing to earn mid-teens type of ROEs. But I think the problem is, at any point, for it to make sense to investors, the cost of equity should be lower than the return on equity.
Okay, so put it in a nutshell. If you had, a spare $20,000 personally, would you rather invest it in JP Morgan, or would you rather be investing it in, Access Bank or Guarantee Trust?
Well, it's quite a different question. Yeah. One, because probably I really don't look at JP Morgan, but I think it depends also on the horizon. I think if I'm going to buy it for my 5-year-old daughter's university fees, then I'll probably go with the Nigerian banks.